Hey everybody, Smart Silver Stacker here. Got something a little bit different for you today, but it's something I think you are really going to enjoy. I recently had the pleasure of having a conversation with Sean Foo regarding silver, gold, the global debt crisis, and the future of precious metals as money. And if you're not familiar with Sean's work, he's a macroeconomic analyst, entrepreneur, and YouTuber based out of Singapore, and his analysis of global markets is some of the best that I've seen. And I'm really happy to be able to share some of his insights with all of you. So, without further ado, Sean Foo. I've got Sean Foo on the channel today, everybody. Welcome to this
Hey
interview.
guys.
And I want to say a big thank you to Sean for taking some time out of his busy schedule to join us today. And I will have given you a brief introduction in the intro to this video, Sean, but why don't you go ahead and tell everybody a little bit about yourself?
Yeah, so kind of run the YouTube channel Sean Foo, and like you guys, right? I'm more of a gold and silver stacker. I kind of started out in the gold space, and then over time I discovered more about silver. And I think that started when I was like 22 to 23, to be honest. I'm currently 35, although I don't really look the part. Some people are saying that I'm like 20 or 25. I mean, that's a compliment, right? But um the thing about gold and silver today, right? I mean, let's just jump straight to it. I think it's more important than ever. That's the thing. I mean, we kind of look at all the chaos going on in the world. I mean, it's like every single week, every single day, something new is coming up. I mean, like just this week, Biden, he just vowed revenge against Saudi Arabia somehow. And last week we had the Bank of England crisis, right? Pensioners were gonna go broke. And with all this crisis stacking up, right, I think it's more important than ever to actually get ourselves prepared with gold and silver. I mean, that's the base of it. Like quite a bit of my content, like I'm sure you would know that it's about macroeconomics, right? A lot of the big picture stuff. But at the end of the day, if you really don't have that base layer of gold and silver, everything else is moot.
Yeah, I would agree with you, certainly. And I've been watching a lot of your recent analysis of the situation regarding the OPEC production cuts. And I mean, you have some really great in-depth analysis about that. I want to get into all of that in today's interview. First off, I kind of want to touch on the subject of the debt market and the ongoing debt crisis that we're experiencing. It seems like liquidity is starting to decline in debt markets around the world. Like you touched on just now, the Bank of England has had to come in with emergency bond buying measures to keep the UK gilt market, the yields on those stable. And, one interesting thing about this that I'd like to get your take on is the Bank of England, they've had to come in with this emergency bond buying, and yet on October 31st, they still claim to be committed to beginning their program of quantitative tightening. And to me, that seems pretty interesting that, they're going to have emergency bond purchases announced ending on October 14th. And then they think that somehow something will materially change between the 14th of October and the 31st that will allow them to return to quantitative tightening. So what do you think about that plan of the Bank of England to begin selling gilts back onto the market on their balance sheet? And do you think there's any chance of that working?
Well, I think they're trying to juggle two things at the same time, right? They're seeing the immediate crisis, which is the pension funds going broke. And as much as I hate to admit it, I think that's the bigger crisis, right? At this moment, just imagine, like, I guess it was 10 or 30 million pensioners are going broke. And, if they do go broke, it'll cause riots on the street and the entire Liz Truss government will collapse, I mean, instantly, right? In a sense. So, in a weird kind of sense, buying into the bond market at a time, trying to keep it stabilized is good, but they're just kicking the can down the road. They're going to encounter this situation going forward, right? I mean, it might not be a total collapse like today, like, I mean, the last week that we saw, but it'll definitely be a kind of stagflation hell where you have yields high enough, you have interest rates high, and at the same time, you have inflation high with all this new money circulating around. And now, I guess you were saying that they're going to do quantitative tightening at the same time, right? So I think that is the big struggle going on. Are they able to actually, pull money out of the market without letting the bond market collapse once again? And how are they going to do it, right? Because the markets are already wisening up to the entire action of it, and they are not really like the Federal Reserve. They don't really have like a Fed funds to declare or something like that, which is just as effective as the Federal Reserve, right? Because it matches directly with the treasuries. So this is the big problem with the gilt market, because it's a much smaller market compared to the treasury market. So any small move will immediately have a reaction in a weird sort of way. I hope that helps.
Yeah, absolutely. And I think you touched on something important there. It's they're trying to do a juggling act, and it seems like recently central banks and governments in the West specifically are trying to always have their cake and eat it too. You know, they don't want to acknowledge the fact that they're kind of stuck between a rock and a hard place. And I think that this is going to have implications for the Federal Reserve as well moving forward. And there's a possibility of this crisis spilling over into the US debt market. And you know, it's not surprising to me that liquidity is drying up in these debt markets, because it seems like investors are becoming aware of sort of the end game of what this whole fiat experiment is going to be. And the yields just aren't high enough to compensate for the levels of inflation that we're seeing. I mean, you know, who would want to buy the government debt when it's basically a guaranteed loss at the rates that are being offered? But it doesn't seem like rates will actually be able to move high up, you know, high enough, because of the overwhelming level of debt that is held by governments and the inability for them to service that debt at these higher interest rates. And, you know, it seems to me, at least from my perspective, that eventually a Fed pivot similar to the BOE pivot is going to become inevitable, because the Fed, you know, there's going to be, like you said, a lot of political pressure at some point when markets really start to fail and when something breaks. And what are your thoughts on, you know, what could potentially be the trigger for a Fed pivot? And what do you think the likelihood of that is in the relatively near future?
Cool. All right. So let's talk about the enormous debt that we are having, right? You know, the argument that we can't really raise rates to a certain point because the debt will get out of control. I think if I'm not wrong, American debt now is around 31 trillion. Maybe it's 32 trillion, but I think it's 31 trillion,
Just
right?
past the 31 trillion level, yeah.
Oh man, that's horrible. But in the sense, right, I have a bit of a differing opinion. I believe that the rates will still go higher, definitely to a certain point. We'll come to a point where it'll pivot, but it'll go higher than most of us think that it will. I mean, there's a lot of consensus out there that it could stop at 4%. It could stop at 4.5%, or maybe 5%. I think you could definitely reach 5 or even 5.5. And this is my reasoning. I think we have seen over the few years, right? Especially, I think 1 year or 2 years ago, when there was a government shutdown, when they were deciding whether to raise the debt ceiling or not. Finally, it was passed. They did raise the debt ceiling. So my take on it, my opinion, I would guess, is that they would kick the can down the road. I believe that they'll raise it to 35 trillion. I believe if things goes bad enough, they'll just go all the way to 40 trillion, because you kind of have an idea of all the insane schemes that they're taking up in Capitol Hill, right? I mean, there was an idea of the $1 trillion platinum coin. I'm sure you heard about it. Something about taking a $1 trillion coin. I don't even, it's so convoluted. I don't even know how it works. You either place it at the Fed or you place it at the Treasury or something, and you have suddenly $1 trillion to pay down the debt. Right?
Yeah. I think the idea is that they mint the coin and then the Treasury holds it as an asset, and suddenly they've, you know, magically solved the problem. I mean, of course, if everything was that simple, it would be great. If they could simply fix, you know, the crisis just by minting a coin or by writing a law, that would be ideal. But you know, I'm pretty skeptical of those plans and how effective that would actually be.
Yes, but I guess it'll come to a point where the debt will be too big to ignore. I mean, it's one subject of my next video. I think it's coming out next week or something, but it'll come to the point where you'll get too much above GDP. If I'm not wrong, it's around 125% of GDP, the debt to GDP. And once it reaches a point that the amount of money the federal government takes in is not enough, at least in percentage-wise, to service the debt. Let's say it's 30%, let's say it's 40%, then suddenly the entire market will get very jittery about it. They'll be thinking, oh my God, can America actually pay off its debt? Now they have to use 30% of the tax revenues they bring in order to pay the debt. What's going to happen next? And I guess you kind of know that it'll be a spiral, a doomsday spiral, right? The rates go up, suddenly the debt even becomes more impossible to service. And because the debt is more impossible to service, more people run away. And yes, that will make the yields go up even more. So it's like a doomsday spiral. And this is where I believe that you're right about pivot's going to come. And that's the thing. They're going to flood the market with liquidity again, sooner or later. And I'm not so sure how they're going to do it. Are they just going to force the Fed funds rate all the way down, just suddenly declare it at 0.5%, 0%? Or are they going to give out steamy checks to everyone, plus push the rates down? And I guess this is the big fear of, are we going to get suddenly runaway inflation for a long time? Or is it going to be one gigantic spike where everyone suddenly gets poorer and then we'll be back into fantasy land again, but everyone's broke and the whole system gets reset? So I don't have an idea of how things are really going to reset, because the Federal Reserve, they have a lot of tools they can play, and I'm sure they are right now, scenario planning what to do. And man, I can't read Powell's mind. All I know is he's going to take rates up, at least for the short term.
Yeah, he seems committed to that. And, we just got the CPI numbers, I think, about 45 minutes ago for September, and they were hotter than expected. I think we got 8.2% year over year inflation. Food and shelter were higher than expected. Gas was down slightly, although I do want to talk about fossil fuels here shortly, because I think that the gas price is probably going to resume its move higher soon. That's, some interesting commentary regarding the Fed pivot too, because yeah, I think that you're spot on there, that with interest rates moving up, eventually, when you have $31 trillion in debt, every increase in interest by 1 percentage point, it's an extra, $310 billion. So
Right.
eventually, it's not going to take too much before the debt service becomes the single largest item in the federal budget. And I think that's, sort of like a point where you've crossed the Rubicon and there's no turning back. Although, probably there's no turning back already, because I don't think there's any way to pay these gargantuan debt levels except by perhaps devaluing the currency. The other option, of course, would be a default, and perhaps, the debt getting paid pennies on the dollar. But I think history tells us that typically governments choose the, kicking the can down the road as long as they can option, and they'll opt to inflate the currency away. And, this brings us back to gold and silver, because, I talk a lot about silver on the channel, obviously, Smart Silver Stacker, and gold as well, and other precious metals. But, I think that, one of the things I do is I'll extrapolate some price targets based on ratios and historic data and stuff like that. And people seem to think that I'm referring to it being some kind of like pie in the sky, get rich quick scheme. But the thing is, if the silver price goes to $10,000 or $5,000 or something like that, it doesn't mean that, things are great. I mean, it means that the whole economy is resetting, like you said. And I view gold and silver more as a way to, rather than to profit from the decline, just as a safe haven and a way not to get wiped out, and a way to preserve wealth to whatever we see on the other side of that reset. So, I mean, are you kind of on the same boat as far as physical metals?
Yes, exactly. Well, okay, I kind of see it in two ways, and both ways, I guess you would agree on it, right? So let's talk about gold and silver in the sense that it's a basic store of value. Let's talk about it as a basic store of value, right? If times are, the normal inflationary times that we're going through right now, 2 to 5% a year, well, gold and silver, for the past 30 years, for the past 100 years, for the past 1,000 years, yes, actually stored value. I'm sure I guess you're sick of the old adage that, a gold coin can buy a fine man's suit, and 1,000 years ago, the Roman
Yeah,
armor.
Roman toga.
Yeah, I
Right?
want to
Yeah.
dig my eyes out when I hear that, but it is true. It is true to a certain sense. So as long as the system still works, gold and silver still does preserve value, but not as much as, for example, the stock market in terms of performance, because it's bolstered by all this funny money, all the printing, all the low interest rates. So there's a big disconnect there. But what I would say about gold and silver, especially the physical stuff, not the paper stuff, the physical stuff, it's a credit default swap against currency crash. So it's a store of value, but it's a credit default swap as well. So let's say one day the entire system gets blown up. Maybe it's next year. Maybe it's 10 years, in 10 years' time, right? Gold and silver will suddenly have this great revaluing spike up. Whether it lasts or not, I mean, maybe it will. Maybe it'll fly to $10,000, then it'll drop back down to $3,000. Who knows? But at that point of time, if you actually held the metal, physical metal with you, you have so many options around. Let's say you have a fixed rate mortgage, you have a mortgage that's fixed in dollars, and that won't move, right? And let's say you have a pile of 10 coins, you have a pile of 100 coins or whatever, you can suddenly cash it out, pay down the mortgage, and suddenly so-called you're debt-free in a sense. And that's one very powerful idea of physical metals, because as we have seen so many kind of chaos going on, it is not improbable for the physical market to decouple with the paper market. It is not impossible anymore. I mean, you just look at 2020, 2021, 2022, it's like each year is getting progressively worse. It is not impossible for the two markets to really diverge. And this is the thing that a lot of people, I'll just stay in the ETF, Sean. Why the hell should I want to pay 5 to 10% premium? I'm like, yes, I'm in the ETFs as well, but 80% of my metals are still physical.
Yeah. Yeah, I think that the paper silver market is acceptable for, speculation. Same with miners, I mean, buying miners is great, I think, in today's environment because, you're basically buying the gold and silver in the ground at a huge discount. But I don't think that that is nearly as reliable a store of value in the event of, a currency reset or a massive debt crisis where the system blows up. I think there's a good chance that those assets, are going to be shown to not have the underlying metal in the case of the ETFs. It's going to be like musical chairs. And I think that those are likely to get settled in, just fiat. And then same thing with the miners. There's always the risk that miners could be nationalized or something like that in the event of a, massive debt crisis, because at that point with a system reset, I think kind of all bets are off as to what, is going to happen as far as the property rights and rule of law and that sort of thing. And physical metal, I mean, the nice thing is there is no counterparty risk. And, people talk about confiscation and stuff like that. But in the past, even though there was that executive order from Roosevelt outlining the ownership of gold, I don't believe there was any actual confiscation. And, very few people actually faced any consequences under that. So it does seem to me that like physical metals. I like your analogy as a credit default swap. I think that's a really accurate description of the role that physical metals play in a portfolio. And the decoupling between the paper price and the actual metals market, I think that's an interesting thing you bring up because, it seems to me like we're already seeing that to some extent with the rising premiums on physical bullion products. I don't know what the market is like in Singapore. I'd actually kind of like to hear your, on the ground report from what, physical metals are like over there. But in the US, at least, I mean, a gold eagle is going to cost you maybe $200 over the spot price, and a silver eagle in some cases is almost, double the cost of the price of spot to get your hands on a new mint gold or silver eagle. And so, I think we may already be experiencing a decoupling after a fashion. What do you think about that?
All right. Well, the thing about in Singapore is the physical market is definitely going up, but I would say it's not as bad as the situation in America. I mean, I could get like a gold bar. I mean, mainly I'm buying bars nowadays. I used to do American Eagles, I used to do Maples, but now for a 1 ounce bar, I think I can get it around 3 to 3.5% premiums, but they're going up. They're going up to 4. They're going up to 4.5. And that's getting quite noticeable over here. But you gotta understand that at least in Singapore, we have more, we are an Asian culture, right? We are quite cosmopolitan, but then at the end of the day, we're Asian as well. So there's a deep heritage when it comes to buying gold. So everyone goes out to buy gold. They buy it for their birthdays. They buy it during Chinese New Year. They buy it for all kinds of festivals out there. We buy it, of course, to hedge ourselves. So the demand for physical gold in Singapore is definitely rising. And we're kind of seeing the decoupling of the physical markets as well. But I would say that beyond a certain point, this is where my inner skeptic comes in. Are the dealers trying to fleece us? Are the dealers trying to push something else? So we always got to try and find the best deal out there. That's why I'm always like, if the Eagles are going for 40%, I'm talking about silver, going for 40% premiums, why would you even do that? Why don't just go for the maples that are going at 15%, 20%, right?
Yeah, I would agree with you there. And even I've moved into more like the bar space for silver because the kilo bars, the 100-ounce bars of silver, that seems to be where the real value is at the moment, because even on generic 1 ounce rounds, I mean, the premium sometimes is $4 or $5 over spot, which in percentage terms for silver is huge. I mean, that's like a 20% markup over the spot price. So, yeah, I mean, I agree with you. I'm not really in favor of buying the highest premium bullion products,
Right.
although I do think it is telling that, obviously somebody is willing to pay that.
Right.
So, it seems like every time we get a big shock in the markets, or, big price movement in the precious metals, the supply of physical, it doesn't run out entirely, but we do see the premiums moving up, and a lot of online dealers at least run out of stock. And it seems like the physical supply is tighter now than, say, 5 or 10 years ago when I started stacking. There was no concern about the physical supply. I mean, physical metal was abundant. And one of the big things we've seen here in the bullion market in the US is junk silver. So old 90% silver coins. 10 years ago, I used to buy them at spot price. They were one of the cheapest forms of bullion you could get here. And now they're running maybe 30% over the spot price. So the premium on those has crept up quite a bit. And I think that, to me, that's sort of like the canary in the coal mine for the physical market, because they have such a tight supply, because those coins haven't been minted in, close to 6 decades now. But yeah, I agree with you that we need to be cautious about, paying these exorbitant premiums to dealers. There's certainly, something we said for that as well. Now, I would like to, you mentioned how Asian cultures kind of have this history of accumulating precious metals. And
Right.
one thing I've been reading about lately has been the rising premiums on gold in China, and how that is beginning to kind of siphon gold away from other markets. Also in Turkey. So Turkey is experiencing a high level of inflation, something like 80% year over year inflation, and they're have a lot of demand for physical metal there as well. And in India now, I read an article the other day that they have a festival season coming up where there's a lot of purchasing of gold and giving of gold as gifts.
Right.
But the supply there is dramatically lower, because a lot of that gold has been siphoned off to the market in China. Now, what do you think about the accumulation of gold in China? It seems like China is certainly purchasing a lot of metal lately. I know their purchases from Russia have gone up drastically, something like, over 4,000% compared to last year. That was in July.
Right.
I think a lot of this, my thoughts are, it may have something to do with, the Moscow world standard, which Vladimir Putin has mentioned lately, and the potential development of a BRICS commodity-backed currency. So, what are your thoughts on all of that?
Sure. All right. Let's talk about China, right? So I think that the Moscow gold standard, the BRICS currency backed by gold, I think that is still some time away, because right now the whole world is in chaos. Russia's still out there fighting a war. There's a lot of chaos out there, and I don't think there's going to be much attention paid to actually develop a gold-backed currency as of now. The reasons are building. The reasons are building for a currency that's actually backed by commodities, but I don't think there's enough attention span to be able to dedicate to it right now. But when it comes to China stacking gold, buying physical gold, I think it's just purely protection. Because they've kind of seen what's going out there in the markets. They've actually seen, America sanction away Russian assets. Whether that is right or wrong, I'll leave it to you guys, to the viewer, to decide. But they're afraid. They're afraid of their own treasuries. Suddenly one day they wake up, the treasuries are gone, they disappear. And they kind of need a type of asset to hold on, which actually doesn't devalue, right? I mean, what are the Chinese going to hold? Are they going to hold euros? Are they going to hold the Russian ruble, which in reality is also getting devalued quite a bit? Inflation there is still quite high. Even though the ruble is at an all-time high, inflation in Russia is still quite bad. So the Chinese don't really have much options to do it. And they are buying gold at quite a bit of a premium. It's because I believe that they are planning something big with gold down the road. They've been hoarding gold, and there's a bit of a joke saying that, when a gold enters China, it's like a black hole. It doesn't come out. A lot of Chinese production, the gold is actually still located back home in China. They don't really export much out, except for, those kind of fancy gold pandas that we have. A lot of it is located in China. So you kind of have an idea of what is really going on. Are they hoarding all this gold merely just for protection? All right. But why do they need to have like tens of thousands of tons in reality? And that's most likely the case. I don't believe they just have like 2,000 tons. I believe they have like 5 times or 10 times that number. because most likely they want to back up their currency in a sense, maybe not to directly challenge the dollar, because I still believe the dollar will be around for quite some time, but give a sense that the Chinese yuan is something that is more tangible, that can be used in the international community, that can be swapped back for gold so that it can circulate around. Like, there's a lot of people that say the dollar's going to collapse next year, right? And I have a statement that I keep putting out in my own YouTube comments as well. I like to say that you cannot dethrone a world reserve currency in a few years that has over 80 years a head start. They have a head start of 80 years. And you can't just dethrone it in a few years just like that. A series of unfortunate events will have to happen. But so far, the events are happening. And the trajectory is not good. But the dollar is still going to be quite strong for the time to come, right? You look at the dollar index is still rising because everyone's default idea is, all right, there's a crisis, let's go to dollars, right? Let's dump every single currency. Let's just go to dollars and we'll see what happens next. And I think that's the state of affairs today.
Yeah, the strength of the dollar, I think, certainly has revealed that it is still viewed as a safe haven around the world. I do think, to your point about the weaponization of the dollar and the sanctions on Russia, I do think that is a bit of a wake-up call to China, like you said, that they should be looking at, alternative stores of value. And certainly, I think that one thing that China has, going forward or not, whatever you want to say, that they play the long game.
Right.
They're not kind of subject to the election cycles the way that the US is. And so they have the ability to kind of look into the future and structure their policy with more of a long-term view. So I think that, accumulating gold, and also I think, like you said, they probably have a lot more than they actually publicly state. And I suspect that at some point they may actually reveal their true gold holdings, when the time comes. But yeah, that probably is somewhere down the road. Of course, timing markets is difficult. It could be that we get some kind of a major black swan event, and that could change the playing field. And, a lot of people talk about black swans like, oh, a Chinese invasion of Taiwan or the use of a, weapon in Ukraine or something like that. But I think it's important to remember that, true black swan events are things that you cannot foresee. And so, those events wouldn't really fit the bill for that, but there is always the possibility of, an unforeseen event. And the real problem is that because of, the excessive levels of debt and the liquidity crisis that we're facing, that in the event of some kind of a challenging event, the existing system is very fragile, and
Right.
it won't be able to stand up to an event of that nature. And so we can't foresee what exactly might be the event that dethrones the dollar. But when that time comes, the dollar is very vulnerable, and it's in a vulnerable position because of the levels of debt. Now, the Moscow World Standard, one of the things that the stated purpose of that is to compete with the LBMA in the West. And I think it's pretty clear that there is at least some level of manipulation going on at the LBMA. We had that nickel squeeze back in February and March when Russia invaded Ukraine. And there was that Chinese billionaire, Zhang Guangda, I think is his name, and he had that massive short position in nickel. And then when the price spiked up, the LBMA kind of came to his rescue and bailed him out, basically at the expense.
Exactly. They just saved his
longs.
entire fund.
Yeah. So, I think that they're not entirely wrong when they say there needs to be an alternative to LBMA. But of course, I don't necessarily know that a Russian-run exchange would be more trustworthy. I would certainly be hesitant to, deposit money in an exchange run there as well. So that's kind of why I think that physical metal is the way to go, just holding physical yourself. But what are your thoughts on the manipulation of the marketplace? We've also seen JP Morgan getting a lot of fines over the past several years for spoofing the gold market and the silver market. How deep do you think that goes?
Well, here's the thing. I mean, so I kind of did a bit of official calculation. I have one video talking about the paper gold market versus the physical market. And it's so-called all above board calculation. I didn't even touch one iota of conspiracy theory. And it was around 60 to 70 paper contracts to 1 gold ounce at least. So how deep does the rabbit go? I don't know, man. You could double it, you could triple it. But what I want to say about this matter is that there's no point trying to play the paper game. There's seriously no point unless you're like some experienced futures trader. I mean, in my previous job before I started my own company, right, which is unrelated to this field, I was an oil trader before, more of the physical side. So I got to see a lot of the games being played, and sometimes, you just don't want to get involved. What you want to do is just to hold on to the physical. It's just so simple. It's so simple. There's no point trying to speculate on the paper price because there are forces out there that could actually jack it up by 5-10%. And it's not really an tactic move, whether it's up or down. It's just trying to play, use leverage, pump it up, take out a fellow rival, or maybe they are seeing an event and they want to ride on the coattails. And those moves aren't really genuine. Yeah, that's the thing. Like, for example, the Russian-Ukraine war, right? Gold spiked all the way to $2,000. In a sense, was it really genuine? We don't really know. Of course, gold moves up in terms of geopolitical disasters, right? Especially during an invasion. But it didn't attain there. Dropped down to 1900, dropped down to 1800. So if you were like going long at 2000, right? Just imagine you were going massively long. You bought futures contracts at 2000. Now you're getting smashed. You're getting margin calls every week. How are you going to survive? And here, me and you and the audience, we are just happily, merrily buying 1 ounce a month. 1 ounce a month,
Yeah.
1 ounce every quarter. And the guy with the futures contract is dead. He's gone. So there's really no point playing the paper game.
Yeah, I would agree with you. And I think that, using margin or leverage or anything like that in a market like gold and silver that, is, at least we know, somewhat manipulated, to what extent. I'm not trying to go down a conspiracy theory rabbit hole. And I think that a lot of people have the idea that the manipulation extends probably further than it actually does. But yeah, I think that avoiding leverage and just stacking the physical metal, treating gold and silver instead of like an investment as more of just a savings account. I mean, that's always been my approach. And I think that that is a good way to go. Now, I know we're kind of running short on time here, but what do you think specifically about silver and the valuation of silver relative to gold? I mean, if you look at the gold to silver ratio, historically, silver seems very cheap relative to gold. What do you think about that? Do you think that there are some like fundamental reasons for that? Or do you think that silver is genuinely simply very cheap right now?
I have very mixed feelings about silver. Do you have an idea what the ratio is today? Is it like 80 or is it 90?
I think it's around 90, give or take. It kind of fluctuating around 90 at the moment. I could be off a little bit, but it's between 80 and 90, I think.
All right, guys, here's my 2 cents. Don't rip my head out. So basically, I believe that the gold silver ratio of 90 is too high, as in silver is underpriced at that point. But I do not believe it's going to drop to 10:1 or 15:1, right? I got to bring this out, I'm going to get flamed, but I've come to the point
I don't think
really
so.
care.
I mean, I think that you're not wrong there. I mean, in 2011, we saw the ratio, I think, drop to somewhere in the mid 30s, and that was on a big bull run. So, anything's possible, of course, but I tend to agree with you that, realistically and just being conservative, silver is cheap now, but some of the, speculation, and I'm as guilty of this as anybody in some of my videos, talking about the possibility of silver reverting to, the historical average. I think that is possible, but I don't know how realistic that actually is.
Yeah, but I think one thing we got to realize is that silver is now more of an industrial metal than monetary metal, right? I think this is a very important, maybe closing statement that I have to make, that maybe silver investors should really understand. Like, I know there's a lot of hype going out there in Wall Street Silver, and I love the guys there. They're actually doing a great thing when it comes to saving your money in something tangible, right? But I would say having some money in gold is good as well. Because, in the ancient days of, Jesus Christ, where silver was 10:1 together with gold, that made sense back then. But right now, we are moving towards, I hate to say it, but we are moving towards a green future going forward, right? Maybe in the next 10 or 20 years. And in that sense,
yeah, whether we like it or not.
Whether we like it or not, but we still need oil. We still need to pump oil. But whether we like it or not, we are going to that future. And silver is going to be a kind of industrial metal for it. So it makes no sense for the industry to let silver rise to 100, well, I won't say $100, let's say $200, $500, or even $1,000. It doesn't make sense for them to revalue gold and silver into the 10:1 ratio. It really doesn't make sense. just imagine if silver is like $200 an ounce, $300 an ounce, suddenly the amount of silver in your phone will make the cost go up by maybe $20 to $50. And that's enough for companies not to become competitive as well. So there's really a bit of a reality check that we need to have. Silver can definitely skyrocket up. So let's say silver was to move to $100 to $200 by the next year. I can tell you I'm going to liquidate half of my holdings. I'll let it crash and I'll buy back again.
Yeah, I think trading some silver for some gold or perhaps some platinum as well, trading into the other metals and playing that ratio at that point might be a wise decision. All right. Well, I think that we are getting close to the end of our time here, Sean, but I do really appreciate you joining me for this discussion. We'll have to do it again sometime. I mean, I really enjoyed it. I'm sure everybody watching took some interesting information away from this. Why don't you tell everybody where they can find you and where they can hear some more Sean Foo analysis?
Yeah, sure thing, guys. Just go to YouTube and just type in Sean Foo, right? I mean, just type in SEAN spacebar FOO. And yeah, more or less, my face should be plastered there. I think I'm the only person there with my name who has a bit of an audience. And when you listen to me, basically, you'll learn more about macroeconomics. We'll touch quite a bit on gold and silver as well. Right now is oil. We also do a bit of the debt market. So a bit of everything out there. But I guess it's all, at the end of the day, it's all about gold and silver. If there's only one investment I would make, I continue my own business. Let's say you're doing a job and you don't want to put any money elsewhere into the stock market. It's always wise to hold some gold and silver because at the end of the day, right, you're insulated from all the chaos and the mess out there. People can't take it away from you. They can't confiscate it from you. And it's just going to hold its value, guys. I don't think I have much else to say on that.
Yeah, I would agree with you. We're living through uncertain times, and so holding some, real physical, tangible assets, I think, is a wise decision. Of course, not financial advice. We got to mention that. We got to throw that disclaimer out there. But yeah, I think that would be that is sage advice from Sean. And everybody, I think you should go check out Sean's channel. The analysis on there in terms of macroeconomics is really excellent stuff. I've been enjoying his videos a lot lately. So thank you very much, Sean, and we will have to do this again sometime.
All right, man. Cheers. See you, man.
Cheers.